Good evening and welcome to Money Matters. I'm your host, Brian Kohute from HJ Wealth Management. My co-host is Pat Dunn from Merrill Lynch. We just heard she celebrated her 40-year anniversary there. Our special guest is Lemke from Ellis Investment Partners. So stay tuned. We're going to have a great show ahead. Pat, great to see you again.
Great to see you.
As we always warn our viewers, this is delayed, so don't make any decisions off what we discuss. But I guess whenever we discuss it, we usually talk about market volatility. We're in for a rough one lately, so what are your clients asking you? What are you telling them?
Very good question. This volatility is a throwback to what we had in '08, and it has a lot of people very jittery.
Yes.
But unlike '08, at this time, the fundamentals are sound. This market seems to be driven more by fear than anything else. Certainly oil has been a big player in this. We have oil prices at historic lows. But even that seems to be getting a little bit better. We're starting to see some cuts in production.
So oil going down seems to be a positive to most people, yet in the market it seems to be a very big negative right now. Well, what do you see? Why is that? Why do we seem hinged to oil right now in the direction of it going?
Well, you're absolutely right. The drop in the price of oil is actually an economic stimulus for everybody except the energy companies.
Yeah.
But if it costs less to fill up the car at the gas tank, you've got more money to spend on consumer goods. Yeah. So it costs less money to transport goods across the country. So it helps the trucking industry. It helps the airline industry. The only people it hurts, of course, are the producers themselves.
Yeah, and years ago it was a demand issue, right? We seem to have a lot of oil right now. There's tankers sitting with it, so I guess it should be low. There's a lot of supply out there, right? Some basic economics.
We have more oil than we know what to do with right now.
So I love it when I go fill up. I keep checking the price, like, is that right? Is it that cheap? So, I guess with oil, we also have to talk about China, which has seemed to be the other wild card added to this volatility. What's your outlook? I guess, the fear is China's really slowing down, and I guess they're saying, can they drag us into a recession? Which some people may think they can, a lot of people don't, though. So
I don't. I'm definitely in the camp where they can't drag us into a recession. It's a real problem, but it is their problem. Right. So I always tell my clients, I said, the real issue is not the fact that China's having a problem, but rather it's the issue that what impact will it have on our economy? Well, it's only going to have two impacts, on our exports and on our imports. And on our exports, we export to China as a percentage of gross national product a little bit more than 0.5%.
Right.
So it's not going to affect our exports. On the imports, on the other hand, because of their falling currency,
right, and
our strong dollar, their goods are coming in here much less expensively, which means it's an economic stimulus. Right. So I do not see China's problems coming here at all.
Good. Well, that's good. Obviously, being a money manager, clients want to know, what are you doing about it, Pat? What are we doing with my portfolio? Sure, that's the question you're getting because I'm getting it too. Are you doing anything? Are you telling clients, sit tight as long as you got it right, your allocation?
I've been at this for 40 years, like I said, and you never win.
So you've been through a couple cycles?
I've been through this a few times, and you never win by selling in the middle of this.
That's right.
I've been telling people, let's go back and reevaluate. What's your asset allocation? Have we strayed from the asset allocation? Is it time to rebalance? Where are we having negative exposure due to the rising dollar that we might be able to shift in a different direction? Going forward, what industries should do well? What size and style of stocks should do well? So really, it's just a time for tweaking. It's not a time for doing anything dramatic. How about you? What are you telling people?
No, I agree. Being an asset allocator and a planner, say the same thing. Nothing's changed because the market went down.
Right.
We always say if we got our time horizon right, we're fine.
Exactly.
If we got it wrong and we failed, then if you really want to be out of the market, then we messed up on time horizons, right? Because we're investing for the short term.
Instead of the long term.
Right? So, But it's a great point. You get that same call. Well, let me sit it out till things get better.
No.
I'm like, well, so you tell me you want to sell low and buy high, because that's what you do, right? Because things get better when the market goes up, apparently. So, allocation's the name of the game, and sticking to it and having a long-term strategy. And it worked in '08 and '09. And No reason it shouldn't work again this time. So.
And just bearing in mind that markets are driven by fear and greed.
Right.
And right
And
now
it
we're being
swings
driven
both ways.
both
Right?
ways.
Yep.
And we're being driven by fear, but that fear is not justified in the fundamentals.
Right.
So hang in there.
Good advice. I guess we can't have a show recently in the last couple of years without talking about the Fed and interest rates. I guess the Fed finally raised rates last year. They're talking about being relatively aggressive this year, but maybe not so much now. What's your outlook, or does Merrill Lynch have an outlook on interest rates and where they think they're going to be?
Well, the Fed last month, and this show was taped, so
Sure.
we have to bear that in mind, came out and said they would not be deterred by the volatility, that they were going to stick to their policy of raising rates. Now, they weren't going to do it willy-nilly. They were going to pick and choose their times. And, of course, on that news, the market promptly dropped 200 points.
Right.
It's like, this makes no sense. And it's not really raising rates as it is normalizing rates. So the growth is still going on in the economy. They are accepting that we are still in a growth, granted a slow growth, but a growth economy, and they will continue to normalize rates. And long term, I think that's good for the market.
Right. Yeah, I mean, they kind of got themselves a little bit of a box, and rates need to go up, and they've been getting pretty good economic data, especially the stuff they focus on, right? Employment's good, wages are going, so it seems like everything's headed in the right direction. So hopefully they'll be slow and steady, but I think we all believe rates are going up. To that point, it's been really hard to get yield, right? If you're kind of a retiree or looking for income, what are you doing with clients to try to get yield?
That is a real tough one, and I'm sure our guest will have more to say about this, but dividend stocks have been a good play. However, if the stock is too big of a company, it's been hurt by the rising dollar.
Right.
So we've been instead tried to focus more on core holdings where you have a diversified portfolio of bonds, domestic stocks, and international. Because I think if we have to pull from principal, we want to pull it from principal that's at least growing.
Right, yeah. So you kind of more of a total return.
Total return.
Let's not worry about the interest or dividends. Let's just get a good and quite honestly, it's almost what you have to do in this environment. 10-year treasuries under 2 or whatever.
Oh, it's
right?
awful.
I mean, the bank, they're charging you to hold your money.
Exactly.
So great. Do you have time for a question?
Sure do.
All right. So Rick Jackson from Ardmore wants to know what is the cutoff in dollar amount for large cap, mid cap, and small cap stocks, and what's the advantage of them?
Very interesting question that, Rich, I do get asked rather frequently. And the interesting thing is that depending upon who you ask, you will get a different definition of what constitutes each. But basically, large cap companies tend to be $10 billion and above, ballpark. Whoever you ask may have a different opinion. Mid cap tends to be 2 to 10 billion, and small cap tends to be less than 2 billion. Some companies will combine mid cap and small cap into one category, and they call it smidge.
Right.
Now, as to the advantage, Rich, that's really not an answerable question because it all depends upon what the market conditions are at the time. Sometimes large cap is in favor, sometimes mid cap is in favor, and sometimes small cap is in favor based upon the economic cycle. But traditionally, people look at large cap stocks as being your older, bigger, more stable companies. Not always true. In 2008, we saw some very large cap stocks literally go out of business. We think of mid caps as those medium-sized companies that are continuing to grow. May happen, may not happen, depending upon the business cycle. And small cap stocks as being big enough to finally get listed somewhere, and they got a long road ahead of them in order to become large cap. But the thing to remember is that at one time, Apple was a small cap stock.
That's right.
So it's best to discuss this with your own financial advisor who is more in tune with where we are in the business cycle and therefore where the emphasis should be.
Great answer. If you have a question, here's how you send it into Money Matters.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Welcome back. Now it's time to introduce our special guest, Derek Lemke from Ellis Investment Partners. Derek, welcome to the show. I'm going to ask you about the market volatility that me and Pat discussed, but I guess give us a little bit about your background first.
Yeah, so I've been involved in the financial service industry for about 15 years with a firm called Ellis Investment Partners in Berwyn, where really our specialty, our niche, if you will, is working with that pre-retiree into the retiree market. So a lot of the questions that we're getting from folks are similar to some of the things you guys have touched on.
They must be really nervous now, right? So
there's some big questions out there, absolutely, no question about it.
So what are you telling? Obviously we discussed the market's volatile. It seems like it's been for a while now, but what are you hearing? What are you telling your clients?
I think our conversation is really in line with some of the direction that you guys pointed out. And what we'll talk to clients about is again, looking from a macro position, kind of a big picture situation is, we'll first just review the U.S. economy. And from there, we'll talk about three legs of the stool. So we have the U.S. economy. We'll try to compare that to maybe an international economy, i.e. Europe, Asia, more of a developed market. And then we'll contrast that to the third leg of the stool, more of an emerging market, maybe in India, China, Russia, something like that. And when we look economically across those three areas, we really feel, at least currently, I think, Pat, you touched on it, fundamentally, the U.S. is probably the best of the bunch. And for some folks, they may not really believe that because I think they're still having some hangovers, if you will, from 2008. But in reality, when we start looking at monetary policy of those three different areas, really the U.S., like you guys touched on, is in a phase of recovery. We've come out of 08 and 09. It may not feel like it, but we really are in recovery phase. So now the Fed has been talking really for about 3 years or so about raising rates. Again, a classic sign of recovery. So we finally did that in December. Whether it was warranted or not is probably a topic for another TV show. But in the developed international markets, really they're on the other side of the coin. They're really where we were in 08, 09, where their interest rate, their monetary policy is easing. And if you take a look at some of the interest rate markets there, while here in the U.S. we're complaining about interest rates, they're actually negative in some of the economies there. So a much different economic cycle, if you will, there, as well as in the emerging markets, really driven by China, and I think you guys touched on that pretty well. So when we take a look at that kind of macro view, U.S., international, emerging markets, we really feel the best of the bunch, if you will, is certainly here in the U.S. And with that, we borrowed this phrase from another firm, but the idea that we're telling clients volatility is kind of the norm right now. We're experiencing that really at a big level here early 2016, and the term we're using is flat is the new growth. So maybe a different economic cycle where we're looking for growth through appreciation. We're going to try and grow the clients with dividends and try and look more on the value side versus the growth side, and do it here domestically at the U.S. So here in the U.S., again, you guys touched on it, but I think unemployment numbers are better, certainly where they were from 08, 09. I think consumer confidence is certainly better than where it was. So that kind of leads us down that road of probably best of the bunch here in the U.S. Very similar to what you guys talked about. Oil being a big driver, a big question mark. And some of the issues in China really, again, continues to push us in that direction of here domestically here in the U.S.
Well, when it comes to the clients that come to you, pre-retirees and retirees, clearly they're coming to you already with investments.
Agreed.
And I talked about how, we take a look at it in light of the current environment and where necessary, tweak. Is there any specific guidance regarding, existing portfolios that come to you that you're discussing in light of the current environment?
Yeah, that's a great question, Pat. So one thing that we'll see with folks is, it's very rarely that someone will come to you with just cash. Everything's in a money market.
You wish.
Hopefully, yeah. So there are existing portfolios in place. And what we'll try and talk to the folks on first is, what's the economic picture? Where are we economically within those different legs of the stool? From there, then, we're going to try and pull the client back a little bit, because usually the questions are driven by, well, we have stock XYZ and ABC. What do you think? Should we keep those? Should we sell those? And we'll try and deflect that for a short term and talk to the client. First and most importantly is, what's your plan? Where are you currently, and where would you like to be? And so when we really start breaking down that portfolio, we're going to put that on the bench for a little bit. And we're really going to focus primarily on planning. And what we mean by that is, when would you like to retire if you're not currently retired? And if you are retired, how much income do you need? How much income do you need to produce from your portfolio? And once we can get some of those numbers down in a conversation, now we can start to build a plan. And certainly our firm, and I think you guys are probably of the same opinion, that plan is probably a bigger driver of someone's success factor.
Absolutely.
Versus the investments that they have. And there's a lot of studies that kind of back that up. But usually the conversation is, well, emerging markets, China, where should we be, where shouldn't we be? And we'll try and slow that conversation down, focus on the plan. Once we have a plan in place, now we can get very specific in those investments and start to make some recommendations. But to answer the question a little more specifically, the biggest question usually has been on the international side. And we'll tell clients really second quarter of 2015, we started pulling back our exposure to international and basically zeroed out our emerging markets based on fundamentals, which is exactly what you've talked about, Pat. So we're not in this for short-term trading. We're not in for speculation. It's based off of a plan and a long time horizon. Once we've established that guidance and that expectation with the client, if we're on the same page, we think we continue on to the specific investment allocation for that client.
You're absolutely right, because retirement isn't for a day, a week, or a month. Retirement can be 30 years.
Exactly.
So you have to have a long-term
view. Exactly right.
Right.
Yeah.
What a pre-retiree that comes in, how does their portfolio differ when they retire? Is there fundamental changes you make, or? Yeah,
it's a great question. So someone in their mid-40s, that portfolio we would say should or could look different than someone maybe at 65 or 70 years old. So based on that economic conversation and getting that plan built for the client, what we really want to talk about then is, if we have a plan and we're going to support that plan, how do we design the portfolio? What do we really need to do with the X's and the O's to make this plan support itself? So we'll talk about the asset allocation being the first and number one driver of that portfolio. And for folks that really aren't familiar or comfortable with what asset allocation is, we want to make it very simple initially, and then we'll dive in a little further to the details. But what's your ratio? What's your mix of equities or stocks to your bond portfolio to your cash portfolio? And the great thing about the baby boomer generation is with that wealth transfer, what we hear about people in their accumulation phase, really now going into a distribution phase. There's been a lot of great studies that have come out to kind of help that client and maybe reinforce what their planner is hopefully telling them. Allocation. Within the allocation, then we should diversify. But oftentimes we'll see that portfolio driven by our risk tolerance, a timeline, and once we can get those things ironed out, then it's basically usually going to be in that 50 to 60% stocks, maybe 30 to 40% bonds with 1 or 2 years in cash. And that's an oversimplification. We never want to put the cookie cutter approach on any client. So while the answer usually is they want to know what allocation they should be in, we really want to try and back that up to how comfortable are you with volatility? Right. And in the course of 6 weeks, if the market goes down 10%, how are you going to handle that? And usually when the markets are going up, people are okay with risk.
They love volatility.
They love volatility. On the downside, when markets are going down, sometimes that allocation mindset or questionnaire changes. So that's where I feel as planners, it's really important, that contact, that touch with your client, that conversation, again, usually outweighs that particular investment or that product decision. And we really try and remind that to the client every chance we get.
Well, you brought up an interesting point that I run into with prospective clients coming in, and that's the idea that they have a cookie cutter portfolio. Do you have any particular favorites when it comes to a mutual fund family?
It's a great question. Being here in the Philadelphia area, Vanguard is basically in our backyard. And I'll tell clients, it sounds a little bit cold in the beginning, but I ask them to follow with me. I don't really care if they're with Vanguard or Fidelity or American Funds or any particular fund family. What's important to me more so than anything is that their allocation is appropriate to their need. So once we get into that allocation, are they then diversified? So hopefully what we're able to do for them is show them a large cap fund should be a large cap fund, should be a large cap fund. Whether it's Vanguard, Fidelity, or Putnam funds, usually the top 10 holdings are similar. Now there's going to be some differences, and we recognize that. So I'll say at Ellis, we have our favorites, we have our list that we're comfortable with. But again, if the client is married to Vanguard, we're okay with that. Vanguard has some great funds, as does Fidelity, as does American funds. So more important to us is that allocation to the client. And then what we're able to do is then break down those individual holdings, and where we're able to squeeze out some return in what we call this new economy, where flat is the new growth, is maybe through expenses. So if we can take a large cap fund that has a similar track record but has lower expenses, well, we feel that's going to hit the bottom line for the client and hopefully squeeze out some little additional return for them.
So do you find you're more on the passive side to try to wring out fees, or you're indifferent to?
Yeah, that's a great question. It's really going to depend on the individual investment for the client. So on the large cap side, I think we're a little more interested in some more active management, where maybe on the mid cap and small cap side, we're a little more comfortable with more of a passive approach with a lower cost. So we'll call it a hybrid, a little more of a hybrid method.
Gotcha. What are you doing on the bond? We talked about how hard it is to get yield and bonds.
Yeah, that's a great question. Yeah, I'll talk to clients about bonds, and we use a historical chart that shows just each asset class over the years and what was the best performing asset class. And oftentimes the bonds we all know are driven by interest rates. Certainly by the textbook, that's 100% accurate. But what I'll tell clients is if you go back to 2008, our most recent Great Recession, or the timeline from 2001 and 02, where the stock market really had some negative returns. What did bonds do in that time period? Bonds rose to the top. And what I tell clients, the way we view bonds is certainly they're driven by interest rates, and we have to have some specific diversification there to talk about to the client. But we'll view that bond portfolio as almost a shock absorber to the client. And the idea being is that when most folks, unfortunately, you guys touched on this in the beginning, when they start to see negative returns, what a lot of folks will do is they'll sell at appropriately the wrong time, like we talked about. And usually what they'll do then is they'll reposition from that equity position that's lost some value, and they'll move it to bonds. So if my client has a 30% portfolio of bonds, and now there's demand for bonds, i.e. 2008, the price of my bonds are going up, regardless of interest rates. So while interest rates certainly have a huge value to the bond portfolio, what we want to talk about is having a piece of bonds in that portfolio to act as a shock absorber for the next recession. Because as we know, at some point the market will go down. No one knows what's going to happen, next quarter or next year. But if we truly are planning for a 25, 30-year retirement timeline, to me that bond piece has a great value to allow rebalancing when the equity piece goes down to take some profits off the bond side.
Well, let's switch the table here for a moment and talk about it from the client's point of view. What do you see as the number one mistake made by retirees?
That's a great question. I would say the client's usually biggest mistake is a lack of a plan, is a lack of a retirement plan. And oftentimes what folks are going to focus on is the investments. What fund family, active versus passive, growth versus value. And what we'll say, that plan usually is going to have a much bigger impact on that actual investment plan. So usually the biggest mistake is that lack of that plan. Or if there was a plan, it was a 50-page document that the client really doesn't understand anyway and hasn't reviewed in 3 years. It went into a binder and hasn't been looked at since. So that ongoing review of the plan with those tweaks, those adjustments like you talked about, Pat, really to me is the much bigger issue for trying to keep that client on track.
Yeah, and it just seems to me is from what your point is, it's hard when a retiree or a pre-retired comes in because they have this like pool of money and it's probably fragmented and all over the place, and they have no appreciation of what kind of income, right? Because it's all been in 401k plans. They're like, well, how much can I live off of? And I think they don't appreciate, like, I guess everyone's using like a 4%. Withdrawal or whatever, but they don't appreciate how much they really need to accumulate to kind of replace their lifestyle.
What does it take to retire? And that's a great question. And I always tell folks if you're going to design your retirement plan when you're 63 years old, well, I guess better than waiting until 64, but it usually starts many years before that. And I think we all recognize that, and sometimes clients don't want to know, and some clients do. So the idea there is it takes a plan. With that plan, we establish a direction, and there'll be curves in the road. I think we all recognize that, but let's at least make sure we're going in the right direction towards retirement.
What's the number one question you get from clients, a new client?
That's a great, yeah. So usually the number one question, there's usually two top questions, and it's usually the 60 to 65-year-old, and it's, Derek, when can I retire?
Right.
when can we do this? When is it reality time for me to be able to punch out? And I'll tell the client, we'll try and make things simple to begin, and then we can dive into details if necessary. But I say, well, Mr. and Mrs. Jones, if you're going to retire, keep in mind your income is no longer going to come from your employer. Your income is now going to come from your assets. So what we really need to do is come back to that plan, review it, make sure we understand, but let's take all your assets, your 401ks, your CDs, wherever your investable assets are, and we'll put them in the figurative bucket. Okay, so now we have this bucket. And Mr. and Mrs. Jones, I'm going to put you on an allowance. You're 13 years old again, and you're going to be on an allowance. And the idea is if you can live on that allowance, or you agree to that allowance, and Brian, to your point, that withdrawal rate, now we're within our plan. And we'll have to make adjustments along the way. I think we all recognize that. But that idea of taking a predetermined allowance out of the bucket, living on that, plus maybe pensions or Social Security, really is how we start to talk to clients about when can you retire. Well, really, it's if you can live on that allowance.
Right.
If you can't, well, we need to talk a little more about the plan. Can we raise the bucket? Can we live on less? Is part-time income an option? So there's some wiggle room there, but we want to try and have that conversation in our 50s as opposed to, the month before retirement.
It makes a tough conversation easier if you have it earlier,
Exactly
right?
right. We have a little more time to work with.
And they have a greater idea of what reality could be.
Exactly.
And if it's not something they can live with, they've got a little bit of time to make some adjustments.
They have some time to make some adjustments, yeah.
So Derek, we have about a minute or two left, though. What else would you want to tell the viewers? Obviously, start planning early.
Start planning early. I would tell clients, I would tell viewers, probably the most important part to this whole retirement planning scenario isn't so much the fund that you're in, the economy that you're in. It's more of, in my opinion, the relationship of the person you're working with. That to me is the biggest factor that I think that clients tend to appreciate when they're in a good relationship. They recognize that and they get true value from that, as opposed to folks that maybe aren't in that situation. So to me, that relationship aspect, to have a plan for that advisor, maybe not to be your best friend, to tell you the good, the bad, and the ugly, but to tell you. And now when you have some time to understand that and to recognize where my potential dangers are, where are my strengths, now we can actually make a plan and make some adjustments to that plan to make sure we can have a successful retirement, as opposed to what most folks are dreaming of is the perfect retirement.
Right.
But in reality,
yes,
I would argue there probably is not a perfect retirement, because the lack of the crystal ball really keeps us from having that. Let's make a plan to have a successful retirement. It's usually driven by a relationship that sometimes helps someone be guided along the way.
It's great advice. As Derek said, it's never too early to start planning your retirement. So. Great. So please join us next week. Our special guest will be Mark Schaefer. He's a president of Photosonic Medical. It's a biotech startup company. As always, join us. Your money matters. Thank you.